Timing is everything on Schedule E. For rental income, the IRS focuses on when you can access the money, not when the rental period happens. That's the constructive receipt idea. If cash, a check, or value is available to you without restrictions, it's taxable now. On the EA exam, they'll try to trick you with, "But I didn't deposit it yet." That usually doesn't matter. Advance rent is any rent you receive before the period it covers. And the rule is blunt. You report it in the year you receive it, regardless of your accounting method. So if a tenant prepays January rent in December, it's December income. The only real exception is when the funds are subject to meaningful restrictions, meaning you can't actually access or use them yet. Cancellation payments are treated the same way. If a tenant pays you to get out of a lease early, that payment is rental income, included in the year received. Example: a tenant pays an early termination fee equal to 2 months' rent. That fee goes on Schedule E as rental income. On the EA exam, don't overthink it as capital or other income. It's rent. Security deposits depend on whether they're refundable. A refundable security deposit is not income when you receive it because you may have to give it back. But if the tenant forfeits it, say for damages or breaking lease terms, then the amount you keep becomes rental income in that year. EA exam tip: they love the moment it changes character from refundable to kept. Rent doesn't have to be cash. If a tenant pays with services or property, you report the fair market value as rental income. If you both agree in advance on a price, that agreed price is usually treated as FMV unless there's evidence it's off. Same idea when a tenant pays your expenses for you, like repairs or utilities you're responsible for. You include that payment as rental income. Here's the twist. When the tenant pays your expense, you generally get both sides. You pick up rental income for the amount they paid on your behalf, and you also deduct the expense as a rental expense, assuming it's otherwise deductible. So if the tenant pays a plumber and reduces the rent check, you report the full rent value, including the plumber amount, and then deduct the repair. Net effect may be zero, but reporting matters. Income is also not considered to have been constructively received in which scenario? Here are the choices. An employee gets a bonus in late December but waits to deposit it. Dividends are automatically reinvested in a mutual fund. A landlord gets a rent check in late December but deposits it next year, or the taxpayer declines to accept an award. Think about it. The correct answer is the taxpayer declines to accept an award. If you refuse it, the income was never made available to you without restriction. A tempting wrong answer is the bonus or rent check deposited next year, but constructive receipt usually applies there. The money was available when you received the check, even if you didn't deposit it yet. Ethan converts his personal home to a rental. We're given his original cost allocation between land and building, later improvements, and the fair market value allocation at the conversion date. The question asks, what basis is used to calculate depreciation during the rental period? The options include $250,000, $218,000, $270,400, and $245,000. Think about it. The correct answer is $218,000. For a personal residence converted to rental, depreciable basis is the lesser of adjusted basis, or FMV, at conversion, and only the building portion, never land. Ethan's adjusted basis in the house is $200,000 plus the $18,000 bathroom, or $218,000. FMV of the house at conversion is $245,000, so you use the lower number.